Thanks so much for joining us here on 90s Plus. I'm Chris Bianchi, and today we're going to focus on the economy with rising inflation, of course, and fears of a looming U.S. recession. So for a bit more on that, to kind of break that all down for you, we're going to try and get you some of those answers here on 90s Plus. And to do that, we're joined by Markus Schneider, an associate professor of economics at the University of Denver. And Professor Schneider joins us now for more on some of those economic concerns and broad economic topics. Professor Schneider, thanks so much for taking the time to join us here on 90s Plus today.
It's my pleasure to be here. Thanks.
Well, my first question for you, it starts with inflation. And where do we stand in terms of inflation, in terms of how much things are growing, and perhaps some historical context on it? And also, do you anticipate inflation getting better or worse anytime soon?
Yeah, so I'll just preface here with that I'm very much a data guy, and so looking at this, I sort of defer to people who make forecasting their primary live stream, like the Fed. Now, their preferred measure is actually the personal consumption expenditure measure, not the CPI, which is making bigger headlines because it's historically showing, the CPI being the consumer price index, it's showing historic levels of inflation and price changes. If you look at the PCE that the Fed looks at, it looks a little bit more modest. It's still historically very high, around over 5%. And they're looking at that index without energy and food because, and I'll talk about sort of why here in a second, but those prices tend to be very volatile. And if you look at the PCE, it's actually leveling off now for a couple of months. And so I think those are indications that yes, inflation is going to stop sort of increasing at its very high rate. How far it's going to come down, we will have to see. But that's the kind of short answer to that question of sort of what's going to happen here. And as far as what's driving inflation, I would emphasize there's a lot of, and the reason that sort of we look at PCE without energy and food, is that there's a lot of supply side factors that we know that after the pandemic, supply chain issues have driven up prices in very specific sectors that are creating these headline numbers. And they're certainly affecting households, but they may not be that connected to the domestic economy in a way that we should worry about too excessively, or we should be cautious of what the trade-off is, what we do about it.
Insight there. And you mentioned some of the specific parts of the economy that supply chain issues have been impacting the most. What are some of those areas in the American economy that inflation has impacted more than others?
Right. So one place where you have a big crunch that has driven inflation very high over the whole year is used cars and trucks. And this is partially sort of what happened in rental car markets and those companies reducing their fleets, which was a big feed into the used car market. And so, this is one area where we're seeing that. More recently, what we're seeing is high food prices, particularly in grains and bakery goods. That is very much linked to global commodity prices in that area and the war in Ukraine, who is a major, both Russia and Ukraine are major grain suppliers to the world. Another place we're seeing that is meat and particularly poultry, and part of that is driven by a recent outbreaks in bird flu across poultry producers. So poultry and egg prices have really driven recent food prices.
And of course, all this is having an impact on the stock market and the broader U.S. economy. Obviously, it's been a rough start to 2022 on Wall Street, with the S&P 500 falling by about 13% since the start of the calendar year. What is behind the huge slump on Wall Street? Is it just inflation, or are there other things at play?
I think there's some other things at play, and I would sort of, say here, one of the things that's really important to emphasize, and there's an economist that has done great work in this area for years, named Dean Baker, to emphasize that the stock market is not necessarily a great indicator of economic health. And part of the reason is that stock prices and the stock market going up is conditioned primarily on the prospects of future profits. Well, future profits can be a sign of great growth and companies doing great things, but it can also be a sign of the expectation of lower costs, including lower labor costs. And we have had decades of growing inequality, especially because workers' earnings have fallen behind. I think some of the slump we're seeing in the stock market is because workers are starting to make real gains. And this is going to squeeze profits. It may also be related to some of the inflation numbers that we're seeing as companies with some price setting power are trying to pass on those higher labor costs to consumers rather than letting them eat into profits. But I think that's the tension that we're seeing.
Fascinating. From there over, you mentioned that the stock market may not be the perfect analogy or predictor of what the overall economy stands. That said, a lot of fairly prominent faces, including the chief executive of JP Morgan Chase, came out last week and said that he predicts that the US will fall into a recession in the coming months. There are other fairly high profile predictions of the US falling into a recession in the next few months. What do you think about that?
Well, I stay away from making predictions about the future. I get to be a professor and do that. But, I think that's certainly plausible. And there's a number of different mechanisms. And of course, if we go into a recession, the blame will be placed everywhere depending on what is convenient for messaging. But realistically, there are quite a few channels through which that can happen. One being how the Fed reacts to inflation. If it's very aggressive, it can lead us into recession. I hope that's not the case. I hope it is more cautious. But it's also the global picture, and it's not only up to the Fed what happens here, right? There's lots of instability in the world. There are high commodity prices everywhere, and the economy we know is in some ways quite fickle, where it will be fine until it's not. If we see cascading business failures because of some of these things, and it may be high prices on global markets that drive it, it may be Fed policy, it may be other things that we haven't foreseen yet. It's very possible. And I think a lot of those forecasts of there will be a recession is the recognition that there are so many possible channels at the moment that might lead to that.
All right, I'm going to admittedly ask you a difficult question, especially for somebody who just said that you don't love making predictions. But what do you think that the average middle-class American should or should not do right now with some of these concerns in mind?
That is indeed a very difficult question. I think in part because the average middle-class American is probably just figuring out how to both deal with life as it is, with rising prices, and also with recovering from a pandemic, right? And one of the things that we're seeing, and this is another big driver of recent inflation numbers, particularly in the CPI, is travel costs are going up right as summer's kicking off. Now, they always go up at the beginning of summer, but it's a bit of a worse year for that. We've seen airline prices go really high. It's tough to say what's your best reaction to that. I mean, I think do what is healthy for your family, but keep in mind that you might want to protect some savings, right?
I think that's essentially what I was hoping to hear, and I think that's a really good bit of advice. And it does sound like, I mean, perhaps optimistically, that U.S., as opposed to the pre-2008 recession, the Great Recession back in 2008, that Americans have more savings in their pockets, perhaps with the stimulus in mind from last year as well. So perhaps there are some signs of optimism as well in the U.S. economy.
There are, and I would say it's a little bit twofold. One is workers really have made some real gains. We've had a much more robust recovery than we had out of the Great Recession. That's partially because the policy response was much more robust to the downturn forced by the pandemic. And so, overall households are not as badly off. And you see that I've heard in some numbers where you see something of a disconnect between people are not necessarily optimistic about the state of the economy. That seems to be quite partisan, but a broadly shared sentiment. Yet consumer behavior is not showing that in quite the same way, which unfortunately is quite good for the economic prospects, in the sense that, what somebody spends is somebody else's income. And if you want to keep things going, that's part of it.
Well, I feel like I could talk to you about this for hours. I have countless other questions. I promise not personal ones, but that I have in my mind. But I'll leave it there. Professor Markus Schneider, an associate professor of economics at the University of Denver. Thank you so much for lending us a few minutes of your time, your expertise, and taking some of my admittedly at times challenging questions about predicting the future. That's something that is very difficult. Thank you so much for your time here, Professor.
Thank you. Thank you so much for having me.
All right.